In this video, I'm going to continue my discussion of the very first statement ever published by the Financial Accounting Standards Board back in 1973. Now, probably you guys are saying at this point, and if you're not, you probably should be, man, this is a lot of material. Well, it did cover a lot of material, alright? Now, we're going to talk about exchange adjustments. What is an exchange adjustment? When you buy a particular asset, whether you buy it here in this country or overseas, it's going to be worth a certain amount of money at the time you buy it. Your car, let's say you buy a car for $14,000. Now I know in this day and age $14,000 would probably buy you nothing but a clunker, but let's say you bought a car at $14,000. Alright, you have to record that. If you're owning a company, you have to record that into your financial records at the time you buy the car. Now, every month you have to update those financial records. You have to show a new balance sheet, you have to show a new income statement, so on and so forth. Well, during that month, what happens is that the exchange rate between our country's US dollar and say like Great Britain's British pound changes. It changes just a little bit every day. But that little bit changes again and again and again. It actually changes 5 days a week. And over a period of 4 weeks, it can change quite a bit. So the value of your item will, of course, change because of what is happening in the marketplace. Okay? Now, these changes can occur for several reasons. When you're dealing with a company that deals with overseas stockholders, first of all, let me tell you, when you've got a company, an international company, not everybody that becomes a stockholder of your company is going to be from the United States. You may have stockholders in Great Britain, you may have stockholders in Italy, you may have stockholders from Brazil. So you not only have to present a balance sheet and an income statement in your own currency to show all your U.S. investors, but then you have to show these kind of documents to people overseas in their own currency, because half the time they're not going to really understand what's going on in your currency. Okay? That doesn't mean that some of them might and some of them might not. So you really need to really present that in their currency as well as your own. Okay? And so this exchange adjustment happens because you're now showing these financial documents in their currency as well as your own, and you have to make adjustments because of that. Another reason, companies don't just buy products to sell here in the United States from the United States. It's an ideal thing, hey, all buy American, but it doesn't realistically always happen. Sometimes companies buy raw materials from another country, have them shipped here, and then they manufacture what they need to manufacture, then they sell it to the American people. Alright, well, that incurs accounts receivables and accounts payables. Accounts receivables is that there are people in other countries that are buying your products and having it shipped over there, which is a good thing because that's American exports. Okay, so we want other countries to buy our stuff. Well, that becomes accounts receivable because not always do they have the money necessary to pay you the full amount for the products that they're getting shipped over to their country. Let's say somebody in Great Britain has a bicycle shop and they want to sell 100 of the bicycles you just manufactured. So they'll buy 100 of your bicycles and they'll say, hey, I'll pay you the whole thing, I'll pay you part of it now and I'll pay you the rest of it within 90 days. Say, hey, cool, that's fine. Well, there goes your accounts receivable. Now you have to document that, hey, sometime within 90 days, these people are going to pay you the full amount for those bicycles. Remember, though, during that 90 days, your exchange rate is going to change between the US dollar and the British pound, because remember, it changes just a little bit each day, 5 days a week, for 90 days. Alright, and so therefore, it's going to change. And you have to account for that in your accounts receivables. Accounts payable, let's say you bought metal to build your bicycles with from Great Britain. Well, you said to Great Britain, hey, I want these materials shipped over here. I will have the money directly sent to you within 90 days. I'm going to send part of it now. I'm going to send the rest of it later. Okay, they say fine. Well, there goes your accounts payable. Remember, your exchange rate is going to change periodically until you pay up everything. Alright? And just because you buy products overseas, or somebody buys products from you overseas at a certain point in time, does not mean that they necessarily have the money to pay for that at that moment. So later on, they try to pay you. Well, when they try to pay you at that later moment, they're settling the account, whether it be accounts receivables or accounts payables. At that point, they have to factor in what the exchange rate between the US dollar and the British pound is at the time they try to settle the account. So that's another reason for an exchange adjustment. Hopefully that's really clear to you, and I will cover more of this in a future video, but I think I've overwhelmed you at the moment. Remember, exchange adjustments happen because, one, you're having to show financial statements to other countries as well as your own, so you have to take into account for the exchange rate at the time that your balance sheet is produced, not necessarily for when an item was particularly bought. Two, you have to take into account at the time of the purchase of particular items or the selling of particular items, which makes your accounts receivables and your accounts payable. And you have to take into account for when people are settling their accounts. You're finally able to pay back the people for shipping you all the materials, or somebody's able to pay you back for buying 100 bicycles from you. So that's where exchange adjustments come in. It is important to record all this because, like I said, your exchange rate changes 5 days a week for months and years on end. And it does directly affect your accounts receivables, your accounts payables, and your assets over the duration of them being accounted in your balance sheet and your income statement month after month. Alright, I will cover more in a future video, so stay tuned.